Hi, good morning. Today we'll be discussing about solvency analysis. Before we go to solvency analysis, let us have a glance on balance sheet, a T balance sheet, wherein your total assets are presented here. Total assets, current assets, non-current assets. This amount, I put a question mark here to check how this amount is contributed from, where this amount is contributed from. Obviously, this amount is to be contributed from either debt capital, which consists of current liability and long-term liability, and shareholders' equity. But here, the analysis tells us that what portion of debt capital is used to acquire the total assets, and what portion of equity is used to acquire total assets. So, we learn here that whether a business is heavily financed, a business assets are heavily financed by debt capital or equity capital, and what are the consequences of it. When a business is heavily financed by a debt capital, it will have a burden of fixed interest. So, the company will have to pay interest irrespective of its profits. Not only that, the debt will have lots of covenants. Covenants means like terms and conditions, like what is the aging of receivables, okay, what is the selling policy on credit, what is the aging of inventory. So this and all you need to disclose it to your financial institutions because their money is more than your money invested in total assets. They have right to ask. So you will not have much freedom in operating your own business. Therefore, most of the companies what they like to have is they like to have more portion on equity. But if you have more portion on equity, obviously you'll have to invite more shareholders, more shares, less EPS. Means the profit will be shared by many number of shareholders. It becomes very smaller portion. Therefore, we need to find an optimum level of ratios between debt capital and equity capital in investing into total assets. This we can find from a solvency analysis. Solvency analysis. A solvency analysis is also called as capital structure analysis or long term financial analysis. Long term financial analysis. A capital structure means the portions of debt capital and equity capital invested in total assets. Capital structure defines the portion of debt and equity capital invested in the total assets. Okay. Debt capital. Debt capital consists of current liabilities and long term liabilities. Okay. They carry debt capital carries interest. Okay. The benefit is because interest is exempted from tax, so we'll have tax shield. Having debt capital, companies enjoy the interest tax shield. That is, tax is exempted from, sorry, interest is exempted from tax. This is a benefit. This is the reason why the companies which are operating in highly taxable countries like to have more debt portion, less equity portion, because they pay interest and claim from your revenues income EBIT minus I. Remember in the income statement, EBIT minus I, that is a taxable amount. So EBT, on EBT you will pay tax. Therefore, what you need to do is you'll have to issue major portion of debt, to acquire the fixed asset, total assets. But as we know that it has some the covenants, so we need to better equate. Okay, equity capital consists of preference and common shareholders funds, carry, dividend, fixed for preference shareholders and flexible to flexible dividend to common shareholders. Okay, more share capital leads to less EPS, earning per share. Okay, so that is the reason why if you have more debt here, you will have more interest burden, more covenants. If you have more share capital here, you will have to pay, EPS will be less, so shareholders are not happy. So you need to have an optimum capital structure which will compensate the plus and minus of these issues. Okay, in the solvency analysis, the first ratio is debt to asset ratio, also called as total debt to total asset ratio. It tells us that how much of debt is used in acquiring the total assets, that is current asset and fixed asset. So debt to total asset ratio represents the amount of debt used in purchasing the total assets. Okay, so debt to total asset ratio, if you have more assets, if the ratio is higher, the firm will have higher financial leverage. Financial leverage means higher contribution from external capital, financial leverage, and interest burden. So when ratio is higher, ratio will be higher when maximum portion of assets are contributed by debt capital rather than equity capital. When debt capital is used more to purchase assets, you will have an interest burden, and also it is called financial leverage, means you will have to sign lots of terms and conditions with the financial institutions when you borrow money. A debt to total asset ratio is calculated with the formula total debt to total asset ratio, debt to total asset ratio equals to total debt divided by total asset, which means current assets, current liability plus long term liability divided by current asset plus fixed asset. Okay, so this ratio should be better less than 50% always. Why? Because these assets are to be contributed less than 50% from the total capital. Means around 60-70% should be equal, or 40% or 30-35% should be from debt. So when you say this is $100, this is $100, the total should be around $35 to $40. The remaining amount equity will be $65. Total is $100. It should be like this. So if you have $100 of total assets, better you should have around $35 to $40 funded from debt capital, and remaining 65 is to be from equity capital, so that you will have some grip on the business operations. Whereas if you have 65 here and 35 is your money, so external funding is higher, therefore they will lead in our financial business operations. They will have, the external debt holders will have control over your business. They may put restrictions on selling the goods, they may put restrictions on maintaining your inventory, receivables, etc. So better to have around 40 here and 60 here. So this ratio should be around 40 or less. Okay, the ratio should be preferably around 40% or less. So when you say 40% here, 60% is equity. Less means 38% here, you will have 62%. So this is a good sign that your money is good invested, more invested in the total assets. Okay, debt to total asset ratio. We have one more ratio called debt to equity ratio. Debt to equity ratio. Debt to equity ratio represents the relationship between debt and equity. It explains the relationship between debt capital and equity capital. Debt capital and equity capital means from this 100, what is a portion of debt and what is a portion of equity. So ratio between 40 and 60, ratio between 40 and 60, you will have in this ratio. If the ratio is higher, again firm will have higher financial leverage and interest burden as well. And the ratio, this ratio should be preferably less than 50%, but 40% is good. Why? Because if you have 50%, 50% means here you have around how much? If this is 60, it will be 30. Yeah, 50% is also okay. Debt to equity ratio. So here total debt divided by total equity, and the ratio is total debt to equity ratio. Here shareholders equity, that is super 6. Okay, so this is a formula. Preferably it should be around 50%, but at 40% is more good. So here in debt to equity ratio, we have a long term debt and current debt expressed in terms of shareholders equity, giving that what is the debt portion, and in terms of the total equity invested in the business. But to be more sharpened, as current liabilities create a spontaneous credit to the company, long term liabilities portion only should be expressed in terms of shareholders equity, because that is the external debt long term, and that will have some cost which is called interest. Therefore, let us calculate the other ratio which is more sharper than debt to equity ratio, that is long term debt to equity ratio. Long term debt to equity ratio. Okay, it represents the relationship between long term debt, only long term debt. You don't have any short term current liabilities and all. Long term debt capital and equity capital. If the ratio is higher, obviously the financial leverage will be higher and also will have an interest burden. It should be around 30% or less. Long term debt should be around 30%. Means here long term debt to equity ratio will be around 30%. That is here only long term debt. Long term debt divided by total equity. Here LTL, only LTL. So LTL portion is expressed in terms of shareholders equity, that is super 6. So that is the reason why it should be around 30%, whereas this one is around 40%. Okay. Now the next ratio is interest cover ratio. Interest cover ratio. This ratio is also called as times interest earned. Is also called as times interest earned. So for to know this in clear, let us have a glance on the income statement. Income statement is prepared here. Income statement is prepared here. That is net sales minus cost of goods sold gives you gross profit. Gross profit minus operating expenses will give you EBIT. EBIT minus I, interest. Yes, this is a portion we are talking about, interest cover ratio. How this interest is covered? How much interest is covered in EBIT? Say if EBIT is less than the interest, you don't have any money. You don't have any money. You'll not be paying tax, of course. But what about the shareholders? You have some EBIT, say 200,000 EBIT. You have an interest of 200,000. EBIT is zero. This is the reason why you should calculate a ratio called interest cover ratio. How many times of this interest is covered in EBIT? Okay, say for example, we have an interest of $5,000, means 5 million. Yeah, we are paying an interest of say 3 million. What is EBT? 2 million. And you are paying a tax of 40%. So 40% of 2 million, 800,000. And you are getting home only 1,200. Banks do not like to have this situation. What they say is that by giving interest to your business, by giving some loan to your business, we are getting 3 million, but you are taking 1.2 million. From 1.2 million, how do you pay installments? How do you pay your shareholders? And how do you retain some amount of profit in the business? It is not a good sign. It is not a good sign. Why? Because the earning is $5 against an interest of $3. The earning is $5. For every $3 of interest, you earned $5 of EBIT, your operating profit, which is unfair. But if you have, say for example, 25,000 here, the same thing, how is going to be calculated? Let's see, 25,000, 25 million EBIT, and you are just paying only interest of 3,000, so that your profit before tax will be 22 million, and you are paying a 40% interest, which is 880 or 8,800. Okay, 8,800, and you are getting a net income of 13,200, which is 13,200,000. You are paying an interest of 3 million to the bankers who gave you loan, and you are taking home 13,200,000, which can be used to repay the loan amount installments. You can purchase some assets, you can retain some amount of profits in the business, still you can, even pay dividend to the shareholders. It's a good sign. Banks will ask you that, do you need any support? You need more loans? Let me know. We are there for you. But what about the previous situation? They warn you. They warn you that your business is not performing well. Please, you'll have to concentrate. Else, bring more security from your personal assets, because security is not enough. So, what I mean to say is 25 against $3 means it is around 8 times. 8 times of interest is earned in EBIT. 25 divided by 3. 3 8s are 24. So, more than 8 times is earned in EBIT. Banks like to have at least 7 times of this ratio. Okay, right. Let me see here. It explains the relationship between EBIT and interest. Banks, financial institutions like to have a ratio of more than 7 times. See, it is around 8 times. 25 divided by 3. Okay, 25,000 divided by 3. The formula will be interest cover ratio. Cover ratio equals to EBIT divided by I. Very important, please. Very important. Many times, for every candidate almost, this ratio is asked. Many times. Almost in every examination we have this. EBIT over I. So here if you calculate EBIT over I, 25,000 divided by 3,000. It gives you 8 point something. 8.33. It's a good sign. So 7 times more than that. But these days, because of lots of requirements, it should be around 15 times. 15 times is better, so that the business can grow faster. Okay, so always you will see the ratio between EBIT and I in interest cover ratio.